really excited about this particular call because it is where the rubber meets the road when it comes to Trophy Point's operations. Because as you know, we take first lien or senior positions in real estate in order to provide us a security on our loans. And so we've got to get the collateral, the value of the collateral correct in order to make a proper loan, a loan that'll pay us back, right? And as I say, any idiot can send money out the door, it's getting paid back. That's the real art of this business, of the lending business. Two names I don't recognize on this call, so I'll just give a quick introduction about myself. I own real estate. I teach real estate. I've experienced in lending money for the last 15 years. I've managed a lot of money, of investor money, plus my own, when it comes to allocating capital in real estate. So I love the industry, and I'm not really involved in anything else actually outside of real estate, which could be good or bad, but there's a lot of focus on my end. And of course, I'm a military veteran as well. So Trophy Point, we've finished 18 quarters of performance over the last 4 years, basically 4.5 years. And so that's 18 quarters of performance that we've sent money out the door, across 900 loans, totaling $187 million of originations. And then that's the money that's going out the door. But like I said, any idiot can send money out the door. It's getting paid back. And I'm really proud to say that we've got paid back on 100 million of those dollars as well, which is even more important. And then maybe even more important than that actually is the repeat borrowers that come back to us. And we're proud to say that most borrowers always come back for a second or third loan, which is fantastic for us because we want to work with experienced borrowers. We want to work with people we know, quote unquote, know. And I'm really happy that they appreciate the experience at Trophy Point because we put a lot of time and effort into the borrower experience, which is why we get away with charging what we do, because borrowers come to us with a quick timeline, generally a quick timeline to fund and close deals. And they're willing to pay a higher rate of interest for that privilege. And so we've got to make sure the experience goes right by them. I enjoy helping people. So, if you ever have a real estate question or you're just need guidance on anything real estate or even business related, I'm always happy to help. Feel free to contact me. Mike Martin was a West Point grad who was trying to buy a small apartment, and I pointed out some things. He came to me asking about some repairs I had done prior to him buying it or trying to buy it. And I asked him some questions to look into, and it turned out that the seller was going to screw him over with some unpermitted repairs or unapproved repairs by the city. And had Mike bought that asset, he would have spent a lot of time trying to fix it and probably lose money. So those are the stories I enjoy hearing because in this business, you cannot lose money. It's so hard to make money in real estate as is. It's not like software where, you can have a great quarter, you can have a terrible quarter one quarter and then have a great quarter the next quarter, and it wipes out mistakes in the past. Real estate is a game where you cannot really afford to lose money ever, really, because it's just so hard to recover from that. So if you're new, there's a few names I don't recognize. If you're new to what we do, we are a private hard money lender. I prefer the term private lender, but hard money is also synonymous with what we do. And we take your money, we give you 8 to 12% on it, and then we lend it out at higher rates, and it's backed against collateral. And Rodney is going to tell us about how we value the collateral for us. And, one unique thing about Trophy Point is that me, Nick, and Dave, my two West Point classmates and my partners, we have the first loss on any bad deal or bad decision we make. And we have $8 million of our own money in the fund. And so we do that to be aligned with you, the investor. And so, any mistakes we make, we're going to eat it first. And it's going to be very painful for us before an investor's dollar is touched. And I don't think you could find that in any other investment fund out there. And I think all those things combined with the collateral, the senior position we take, the fact that we have a first loss, we focus on a military affiliated crowd, all those things in totality produce a zero investor capital loss on any of the loans that we've made, which is really cool because we've sent almost $200 million out the door, and not to lose money on any single one of those loans is something we're very proud of. So you have a lot of options in terms of investing, but I'd like to remind you that Trophy Point probably represents the best risk-adjusted return that you could find out there in the market compared to REITs, treasuries, and high-yield stocks, dividend stocks, and maybe even debt outside the country. And then here are the rates that we offer, 8, 10, and 12. And you can see the investment amounts there. The one announcement is that we are changing the threshold for the 12%. It's become very popular. And so we're increasing the threshold to 2.5 million after the end of January. Feel free to contact me if you have questions about this. Happy to talk more about investing and what it's like. And then we have a great offering for IRAs as well, of 10, 10.5, and 12, based on how much money you put in. But like I said, real estate, you can't afford to lose money because the game we're playing is compounding. And so a loss, even a 20% loss, would hurt your ability to compound capital. And Trophy Point's all about compounding the money that we have. We have 75 million under management right now, and we've been earning our investors 10% on average, about 10%, because most investors invest at the 10% level. We've been able to compound money over at 10% for the last 4 years, which is fantastic. And then we also rolled out a referral program. We appreciate referrals, and we've got 200 plus investors, and we've grown a lot of our base because of referrals. And so we wanted to continue that. And we heard you based on the last investor survey from the previous quarter, and we launched our $1,500 referral program. So all you got to do is send a text to that phone number that you have there, and then Danielle or myself will take care of it from there, and we'll deposit $1,500 into your account or pay it to you in cash. So our monthly update. So we're preparing our sort of quarterly update, but also our yearly update for 2024. But as December goes, we earned our investors $1.4 million last quarter. We increased the number of investors to 225, and we crossed 75 million under management as well. And then December was also one of our largest months ever. Actually, we originated about 12 million in loans. And we finished out the quarter with $21 million in loans made, which is our largest quarter ever, actually. And a big part of that was Rodney's team and RicherValues, because we rely on that company to help us do the due diligence and the evaluations of the assets. And we'll dive into Rodney in a second. But anyway, December, November, October, 21 million total lent was our largest quarter. Very happy about that. It seems the last 4 quarters have always been increasing. Last year we did 15 million almost every quarter, and this year almost every quarter was around 17 to 20 million. So we are growing. Speaking of growth, our team has also grown tremendously as well. We now number 23 people, 23 investment partners that span the entire Trophy Point operation. Most of these people are new, but we had to bring them on because the lending business is more of like a pipeline business, and it's very procedural based. And when you close 30, 40 loans a month, or 20 million loans a quarter, which is even larger than some conventional mortgage shops, actually, we've got to get more team members. And so we've expanded the team under Nick and Dave primarily by a lot in order to handle the greater volume. So let's get into why we're here, actually. I'm really happy to talk about this topic this quarter or in general, because like I said earlier, like to get the collateral value correct is one of the most important decisions that we have to make as a lending firm. Because we know the loan, you could make an argument the loan is only as good as the borrower, and that's true. We do underwrite the borrower. But even more importantly, like the real leverage that we have as a lending firm is the fact that, if the borrower fails to perform on the loan, we have the ability to seize the collateral in order to pay ourselves back. So we've got to make sure that we are really good with valuing the collateral appropriately. And it's tough because we are typically in a value add sort of situation where someone's taking a house or an asset in bad shape and then bringing it up to market level or comparable level with what else is going on in the neighborhood or in that area. And that's sometimes an art more than a science. But the science behind it is RicherValues. And I'm really pleased to have Rodney join us. He launched the company in 2019. And Rodney, correct me if I'm wrong, have we been partnered together for the last 2 years, 2.5 years?
Yeah, might be 3. I don't remember the exact date, but a little while.
Yeah, at least 2 years for sure. And I know it's at least 2 years because our bank, we have lines of credit at Trophy Point. And to speak to how trusted RicherValues is even the banks pretty much force us to use RicherValues or want us to use RicherValues to justify the collateral values, because then the banks can use that for the line of credit that they issue us on a per property basis. I know, Rodney, you probably have more to talk about yourself. You've got a lot of experience in the industry, almost 20 plus years. You want to take a few sentences to to describe yourself and how you, and maybe even tell us why you started Richer Values. That may be the best question to answer, actually.
Yeah, you got it. So nice to meet everybody. I'm Samir. Great to see you again. Thanks for having me on. The quick synopsis really is I have been in real estate a long time. In the last downturn, in 2008 to 2013, I helped build and manage a buy-side investment shop where we were purchasing REO and then non-performing loans from banks from the country in that downturn. And when I showed up at the company, we had deployed just a couple $1 million. By the time that I left 5 years later, we had acquired over 1.2 billion in inventory. So primarily single family nationwide. And I was responsible for anything and everything from start to finish, from procuring the assets to investment underwriting to REO asset management. As we started acquiring non-performing loans, we built a servicing company out of Portland, Oregon to service all of our mortgages. And I ran accounting, investor reporting, as well as software development. And so what Samir commented on and pointed out is spot on, is that in real estate, it is difficult to make money and losses can be, devastating, really. And so getting it right is so important. And when it comes to real estate assets, particularly in residential, it's unlike commercial in the sense that commercial is formulaic and residential combines both buyer preferences and kind of emotion together with hard sciences of assets and value and market and supply and demand. And so to go back to your question, why did we start Richer Values? The real reason is we wanted to create a platform to help institutions make better decisions more quickly in understanding the entire market in an objective way. In the thousands and thousands of homes that I bought and renovated and sold and evaluated and bid on, etc., it was clear and has always been clear that the standard products that are in the industry, whether it's appraisals, BPOs, other valuation products, they're incredibly subjective and they could tell or hide a story without really knowing whether that's the truth or not. And so we developed Richer Values to create and provide greater objectivity, more sophistication to understanding not just asset value of, oh, that house is worth whatever, 180. No, a house is actually worth a spectrum based on what level of condition it's in. And how do we better quantify the value based on different levels of renovation? And how much is that going to cost to get there? And so when you start to put the entire analytical package together, it creates more transparency and insight into how is this investor going to make money? Where is the money to be made? Where does it need to be bought at? What is that upside? Where is it not? And so that's where it gets back to the mission of we're really out there to provide greater institutional level intelligence to help financial companies make better decisions in a faster time period.
I appreciate that. So before we jump into Rodney's stuff, we've got a poll, as is usual, gauging kind of people's sentiment, and that'll be important as we talk about what Rodney has to share with us. So I'm going to launch the poll real quick, and feel free to vote. We've got quite a few people on the call, so just go ahead and vote, and I'll release the results once we've got participation. So the first question is, what do you think will happen to single-family real estate values? And the second one is, do you think residential real estate is a quote-unquote more resilient asset class than other investable asset classes that may be out there?
These are good questions.
All right, I'll just end the poll there. So the first question was, what do you think will happen to single-family real estate values? Remain the same, increase, or decrease? And the second question was, do you think real estate is more resilient than other asset classes? So the good news, or I guess good news for us, is one person thinks it's going to remain the same, more people think it's going to increase. And then for the second question, one person thinks it's on par, and then the The rest think it's more resilient. And I actually agree, like with the second question, at least, I think things are going to stay more resilient. I think single family real estate, residential real estate is more resilient than other asset classes for sure. And I think prices will probably remain the same, maybe increase a little bit, but largely remain the same. But I don't think they're going to be a decrease. Rodney, do you want to, as a warm up, do you want to opine on this?
I actually agree with both answers that you just gave.
Oh, good. Cool.
Great. So we already really touched on this. Our company's mission is to provide greater accuracy and deeper insight into what we call the asset level economics of residential real estate. And so this gives a good visual into what we're talking about there. So this is a screenshot of one of pages of our reports that Trophy Point gets on all and most of our clients on all their properties. And so here you start to see, right, we quantify what is an asset currently worth in as is condition and how much do we expect it'll need in repairs, as well as how much might it cost for upgrades if we're going to do a minimum remodel, partial remodel, full remodel, etc. And what do we think the corresponding after repair values are? That's what ARV stands for. And so that helps us understand, and how does the borrower's budget compare to expectations? And so then we analyze the borrower's proposed budget and how does that budget compare, and where is that money being spent? How much toward heavy repairs, deferred maintenance, upgrades, reconfiguration, soft costs? And so we go through a very in-depth analysis to evaluate, does this proposal make sense? And where will this property be worth at the end of this proposed renovation, assuming that it's done in a professional way and we've analyzed all those line items. And our reports are typically back in 3 to 5 days. For Trophy Point, I think you guys are probably averaging more like 2 to 3 days. And that's in comparison to, let's say, the traditional world of appraisals, where the traditional world of appraisal, just to give you, in case you're not familiar, just to give you a comparison. So here on the right, we have a value curve. With an appraisal, you'll typically just get one number, maybe two. You might get an as-is value and an ARV, but most of the time you're just getting one. So if you order an appraisal for an ARV, you'll just get a single number. It'll provide no assessment of costs. Most appraisers don't have the expertise to comment on whether the budget makes sense or not. And so you basically, out of this whole page with a traditional appraisal, you get one number. And whereas here you get an entire page of intelligence. And most of those appraisals, generally in today's market, it depends where you are, could take 1 to 3 weeks to get back. About a year or so ago, people were actually averaging more like 3 to 6 weeks, and we were still 3 to 5 days. So it's about speed. It's about transparency. It's about greater understanding of the dynamics of every property.
One of the other metrics that I personally like in your reports is the percent remodeled. And so I've flipped probably 30 houses myself a few years ago at least. And I always look for neighborhoods where other rehabs or other flips were occurring, because it told me that it's a gentrifying neighborhood or it's a neighborhood that's up and coming. And if that market is accepting more remodels and value add is occurring, I buying a house in bad shape and then fixing it up to sell it at a higher price, then that likely means that my house or the asset that I take over to flip will also take advantage of that dynamic. And so I personally like to see neighborhoods where more flips are occurring in the first place, because it says a lot about the idea of capturing that additional value with the remodel.
Yeah, absolutely. And that speaks to our entire approach is what we call hyper local. So the only other data providers that we know that try to provide market information are really kind of looking at either HPA for the whole MSA, or they're looking at zip code level. And for real estate investors and lenders, we understand that everything happens at the hyperlocal level. So if I'm in this particular neighborhood, I don't really care what's happening on the other end of the zip code. there might be activity there or not. But if I'm in this pocket that hasn't really seen that action yet, it doesn't, the zip code is irrelevant to me. And so we do all of our analysis. There's AI layers. There's a whole bunch of stuff that happens under the hood. And we're doing all that on a hyper-local level. And so people really love that market demand score that we have. And it's really shown to be a very strong leading indicator to market performance over the next 6 to 18 months. So we get to see it ahead of time because it has to do with inventory levels, velocity, and how much renovation is going on in that immediate area. And no other provider has that information. But because we're doing condition-based analysis, again, with AI layers and all this other stuff, image rack and so on and so forth, we're really quantifying, new insights that are very valuable and actionable about every hyperlocal neighborhood that we're analyzing.
Yeah, we really appreciate that from a lender perspective. And then I also wanted to opine or add that the rehab budget number that you come up with, now it doesn't always match, it never actually matches what the borrower says, but it gives us a sense of like the magnitude of what we're talking about. And many times we have borrowers come to us saying they want to put, and I'm being extreme here, but I'll just use that as an example. They want to put a bathtub made of gold into their house. And they think if they put a golden bathtub, that the future ARV, the after repair value, will be like, $500,000. Well, that's a very subjective sort of thing, right? That's very art in terms of determining like what repairs do you want to put in there to add value. And you're saying you're going to put a golden bathtub in, and you're going to say it's going to increase the value by $200,000. But what we care about as a risk mitigation thing is what is the neighborhood going for? Because if all the houses in the neighborhood are going for, let's say, $300,000, it's very unlikely you're going to be able to buy a $500,000 house or achieve a $500,000 valuation on that house if all the other houses are selling at a much lower price. And so when you give us an indication of like the relative rehab dollars required and the relative ARV achieved with, the level of rehab that you want to do, that helps us as a borrower a lot to call BS on a borrower or not. Or at least gives us a chance to ask more questions of the borrower for them to explain why they think what they're trying to do will achieve or capture additional value.
Yeah, absolutely. And sometimes it goes the other way as well, which is, the borrower thinks that they're doing a full remodel, but when we analyze their budget, it's, falls between what we'd call a minimum and a partial remodel. So maybe that neighborhood can fetch 300 grand, but their ARV is 210 or whatever that is, because we're looking at that scope and we're saying that scope, that ain't going to get you to where these comps are. You're doing new counters, but you're keeping the cabinets and you're not even doing new appliances and you're not doing the windows and blah, blah, blah. And look at these comps over there. You can't compare those unless you're going to downward adjust for condition. And again, those are levels of nuance that are super important that unfortunately, in the traditional world of appraisals are often missed. Because again, the appraisers don't typically have the expertise to understand or evaluate the rehab budget, but that's really where we're coming from, right? We come from the investment side, so we've done this hundreds or thousands of times with our own capital. And so we're going in there to analyze, well, what's this budget really going to get us and what's the market impact of that? And so that's really the analysis that is super unique that we provide. I think all of our clients appreciate, as well as, like you had pointed out, the capital partners behind our clients, their warehouse lines, their investors, their loan aggregators, etc. They also really appreciate our services compared to, other stuff that historically people used to use.
Yeah, and the last thing I'll add on the, kind of appraisal versus richer values reports is a lot of times appraisers don't even talk to the borrower on what the plan is. And it's like this static level sort of analysis that's done. But when you look at the rehab budgets, or you get a borrower to submit a rehab budget and they have to talk through what they're trying to achieve, at least at the trophy point level, like the report gives us a basis for conversation with the borrower. And through that conversation, we get a sense of how rational or sane or how legitimate the borrower is in terms of what they're trying to achieve. Many times when they talk to us about their rehab budgets, we realize that this borrower has no experience. They may say they have done a lot of flips, but when they actually talk through what they're trying to do, it turns out they don't, right? And that ends up becoming a loan that we're not going to do because we also care about the borrower experience. And so all I'm really trying to say is the process in which we're employing with Richer Values opens up a platform for us to evaluate the borrower in ways that aren't necessarily realized. It's not just the report, it's the conversation that matters to us.
Absolutely. And, we still probably get about 5 to 7% of our reports across all of our clients come back a second time where the report helped the borrower understand the market more clearly instead of just going off what their realtor or their contractor was telling them, because those folks are conflicted parties, right? The contractor just wants you to have a high scope. The realtor just wants it to look sexy so it can have before after pictures. And they don't really care how much money the investor makes or not. They just care that they get their, the job. And oftentimes after this report comes back, that borrower looks at it and says, oh my gosh, I could actually make more money putting less money in because this neighborhood doesn't really warrant that, fancy this and the gold bathtub and, et cetera, et cetera. It would have been cool. I could actually make just as much or more money by doing a partial reno on this one. Okay, here's a new scope. So then they come back and they say, I've updated my budget. My contractor wasn't happy because I went from a $70,000 budget to a $38,000 budget, but will you give me an updated report? And then they give us a new budget and then we'll reanalyze it. We'll give them a new ARV. But this report and the detail behind it helps lenders and investors understand the mechanics and the dynamics of where is the profitability. So about 5 to 7% of those reports come back with a kind of recalibrated, re-engineered budget that is aimed at project success. And so what's great about that is, number one, that reduces REO risk. Number two, it increases repeat business. Now that investor, when their trophy point loan officer sat and told them, by the way, this is kind of telling you could probably make more money by doing a $38,000 budget instead of a 70. You might want to look at this. When they do that and they finish the job and they sell the property and they make that extra money, which happens time and time again, they're like, wow, this is amazing. I actually just walked away with more cash. What's going to happen the next time they have a deal? They're going to go to some random lender? No way. They're calling up Nick or they're calling up, one of the team members at Trophy Point and saying, okay, I'm ready to do this again.
Yeah, that's true, actually. That's very true. And the borrower also, in that dynamic, that example, the borrower also likes that because we charge as a lender, and most lenders do this, we charge on the total facility amount, meaning not only the purchase price, but also the repair dollars. And so it's in the best interest of the borrower to always get that repair dollar, or at least the borrowed funds on the repair side, as low as possible, because they don't really see that money because Trophy Point lends on a reimbursable draw basis, meaning that the borrower has to spend their money first and then Trophy Point reimburses them. And that's another way we mitigate risk. That's really good to know, actually.
You got it.
Real quick, is Ryan your brother?
He is.
Oh, that's awesome. Great to
know. Yeah, it's great. We get to be in business together. It's really awesome.
One thing that I would like you to talk about is the draws, right? I just actually spoke about it a few moments ago that Trophy Point does reimbursable draws. For those of you that don't know on the call, a reimbursable draw is where the borrower spends their money first on the repairs, and then they send the lender the receipts, the lien waiver, or some proof that the work was actually done, pictures, obviously. Many times, Trophy Point and others, we rely on a third party like Richer Values to do the draw inspection. to further verify that the work was done before we cut a reimbursable check. But Ronnie, I was wondering if you could just talk about draw inspections in general, what you've seen from it or anything of note from it.
Yeah, you got it. Great. And I'll put in context just the quick evolution of our company. Really, we're doing prototype and beta 2017, 2018. Commercial launch was in January of 2019. Initially, just with our software platform that's designed to, it's got unbelievable analytics and is all about, as we talked about, greater objectivity, accuracy. And the goal there was really to get lenders, investors, and other folks using the software to help run their analysis. And what we kept hearing over and over was, wow, this is amazing. You do the work. And so we resisted a little bit for about a year or so, and then started building it out and really kind of doing pilots and stuff in 2020 and really full launch in 2021 with evaluations. So we now provide, and it's probably today close to 90% of our business is providing FIRREA compliant field-based reports where we have inspectors go out all over, and then we have our internal team utilize our software to do the full analysis, analyze the budget, analyze everything as we talked about. And so that business has really, thank God, really taken off and is the main engine. And as we were doing that, and folks were getting their evals back from us in such a fast time frame, clients then kept saying, can you do our draw inspections too? You guys are so fast. Can't you just do that? Because we're not having success with other vendors or this or that. And so in 2023, we basically launched kind of as an ancillary draw inspection services. So to utilize the inspector network and platform that we have to do draw inspections. So let's just talk about that real quickly so that folks understand. When Trophy Point or another lender, whatever, has got a project that now funded, we've got a known budget. It's got 17 line items. And the investor starts, they put forward their money with the contractor and they start doing the work. And then at some point, 20% in, 25% in, say, okay, we need to now demonstrate that we completed these 6 line items so that we can get reimbursement of the first $18,000 of our 70 grand budget or whatever it may come out to. And so the controls and risk management process is great. Now we send someone out there. They've got a copy of the budget line items that need to be verified. And they'll take a bunch of photos and they'll answer a bunch of questions. And then that comes back in. And then our QC team reviews all that. And then it shows, here's the schedule. Here's all the line items that were said to be checked. And this one's at 25%, and that one's at 100%, and this one's at 80% complete. So you measure the percent completion of each of the line items. And from there, the inspection, the system then calculates and says, okay, and we already knew the budget. So that item that was 25% complete was supposed to cost $4 grand. So we approve a reimbursement of $1,000 and so on and so forth. So it filters all down, and then you have a recommended reimbursement amount. And typically we have a 24 to 48 hour time frame where those draw inspections are done. So it's all about speed, which really contributes to borrower experience. They want to be able to get their money quickly so that they can keep their contractors moving and their subcontractors moving without delays. Speed is super important because every day that the rehab is still going on, that means they can't market the property and the loan's still outstanding and they have carrying costs. So speed's super important once everything gets going. But transparency and verification and oversight is critical for the lender to make sure that the money is not just getting used on some other property that the contractor is doing next door and not the subject property. But we need to know Were those photos taken on site, geolocated on the right time and day, and not falsified? And so there's a whole oversight element to this that's super important. So we provide draw inspections. It's a growing part of our business. Like I said, it was really based on client requests, and at the end of 24 we also started launching some automated products that people are using earlier on in their pre-underwriting stages, or aggregators will use it if they're buying loans, etc., when they're not getting a full eval or appraisal.
Cool. I think when it comes to like valuations and this whole game that we play, a lot of it's about like just getting another set of eyes and getting, it's about trust and that trust comes from getting multiple pairs of eyes looking at things. Because we internally evaluate stuff. Now we have RicherValues evaluating, stuff, the asset or the draws. I think it's all designed. I loved how you put the client profiles in there, because there's so many other players involved in this game, and having like, third parties look at these things intelligently, not just appraisers that, just put a number on a piece of paper and then turn it in, is like what this industry is actually built upon. And it didn't occur to me that thought just occurred to me as I looked at like the various profiles that you have, because in some cases, Trophy Point is a lender, obviously, but we are a loan buyer in some cases where we're buying loans from someone that wants to sell us their loans. Sometimes we have been a buyer of the asset in the sense that we are foreclosing on the asset. So we end up becoming a buyer, kind of a de facto buyer of it. And then we are thinking about securitizing. We are thinking about selling our loans to an aggregator as well. So like we find ourselves overlapping all of these, actually.
Yep, great. So I'll just run through this case study super quickly, but here's an example. I mean, this is stuff that happens like every day. So this example was just back in October. Lender in Washington looking at a new construction opportunity in Georgia. Borrower calls him up. It was an inbound lead, and they say, hey, we've got plans, we've got permits in place, we're ready to go vertical, we've done the horizontal, our lender is stalling, and they really need to move so they can get moving. Can you close by Friday? So this was on a Monday. And the lender said, no problem. We got it. So it's in Gainesville, Georgia, 1,700 square foot, 4x2. And the borrower is telling him, great, we're going to put, it's going to cost 300 grand, 312 grand to build. It's going to be worth 480. Great. Sounds great. They gave one comp that showed that, great, here's a 1,750 square foot comp that sold for 520, and we think we can sell for 480. Okay, awesome. So they placed an order with RicherValues at about 4 p.m. Eastern on Monday. And in less than 72 hours, we did both levels of our analysis and the inspection. We delivered the report on Thursday. And what did we find? So number one, we flagged them saying 312. Okay, maybe it's 314. I don't remember. Maybe we had a typo in there. But the budget of 314 grand at 180 bucks a foot for wood frame base level construction, we are flagging as a caution flag. That seems excessive. That is significantly above what our system is estimating, as well as, so I'm going to say, Samir, to your point, it's about another set of eyes. It's also about another set of eyes that are backed with expertise. So the folks that are conducting these analysis reports on our team, they have deep experience in the field. They've been GCs, they've done ground up construction, they've done fix and flips on hundreds of homes, and they know from experience where should things fall. And when we analyze the architectural plans that were provided and we look at the budget, we say, this looks excessive compared to the quality that's being put up, then it's a red flag for potential fraud. Are they pulling money out of that project? So we flag that. The next thing we showed is this thing's only got a 425 grand ARV. So here we had
41 sold comparables within a 2.5 mile.
41 radius. Comps within 2.5 miles. 19 of them within the right size band. Our team ultimately picked 8 comps that are plus or minus 25% above grade square feet within a mile. So the graphic on the right now starts to show the comps that we picked, which includes new build comps as well as full remodel, et cetera, et cetera. So you can see we're now pinpointing. This is not, we've got one comp or whatever. This is some pretty decent activity within that immediate neighborhood of the subject property. And it's small here. You know, this presentation was ultimately given in a large auditorium. So it's on a huge screen and you could see it more. But the point is, those sale prices are not coming anywhere near 480.
And I also appreciate that there's a time component, because Trophy Point, at least as Trophy Point goes, we don't care about comps 2 years ago or even a year ago. We care about comps within the last, 60, 90 days at the most, right? Because interest rates have had such an impact on sales. But it's good that you're respecting that, the fact that the time matters.
Absolutely. And the system goes through pretty deep analytics to figure out how much did the time matter in that hyperlocal area. And so then if you flip to the next page, for comparison, we added that one comp that they gave us, right? And you can see, so our system had all those comps. We picked the 8 that were in the median area that were also new build. And what's the one comp they have? It's in a totally different part of the market. And so, our team came and said to the lender, look, we think you've got a $425,000 ARV and your budget's way too high. So the project for sure could still pencil. But what it did is it flagged them as potential fraud risk of, well, if you bring down your budget instead of 315 grand, more like to 230, 250 where it should be, and sell for 4.25, this makes sense. But there were, questionable risk factors with the numbers that were being presented to them. And so we helped them identify those issues within a 72-hour period from them, getting the lead.
Wow. It's kind of funny that the errant comp was on bogus road.
It's kind of funny. That's funny. And that's basically the overview from our perspective. I mean, like I said, thank God we've been growing. We've got 300 to 500 private lenders that order RicherValues in lieu of appraisals on every one of their loans. There's probably 50 to 100 investors that use our interactive software to analyze all their deals day in, day out. We achieved FIREA compliance, third-party audit in 2023. So that really helped open the door for traditional banks, Wells Fargo and many other banks that accept it on their warehouse lines or in their note finance or loan aggregation. And now our reports have been finding their way into the securitization market as well.
So you have 300 to 500 lenders. Do you know how many reports they're ordering on average each?
A lot of those lenders, the private lending industry is very fragmented. So, some of those lenders might only order 1 or 2 a month, but, some of them are consistent at 10, 20, 30, 40, loans a month. And then we've got a handful that are, typically 50 to 100, 150, orders a month. It varies. So probably a normal type bell curve for B2B type businesses.
Got it. Could you talk about rated securitizations and what that is? I'm kind of excited personally from a fund perspective on the ability to securitize my package of loans and sell it off to reintroduce liquidity back into the fund. But if you could just briefly talk about how RicherValues fits into the securitization process, that'd be great.
Yeah, great. A quick, 2-second overview. A securitization basically means the creation of a bond or financial security on a portfolio of loans so that the lender and their investors can recapitalize it and use that capital typically for deployment of new capital, and it's owned in tranches. So typically it means, let's just say, okay, and normally it only happens in large quantities of loans because of the expenses of getting a deal done. But so let's say Trophy Point or another lender accumulates $100 million or $50 million of loans, and now they take those loans and they package them up and they put them out. They create a security on it so that pension funds and insurance companies and other hedge funds and other financial institutions can go buy that security like they would buy a corporate bond or any other mortgage-backed security. And that security is going to generate return for them. It's the same model as an investor providing capital to Trophy Point. I'm going to provide capital. Trophy Point is going to take the first loss position, and I'm going to get a return. And I'm banking on their expertise and their confidence and their track record that, God willing, my principal should be safe, as every one of their principal dollars has been safe over this time. So the bond buyers are buying for the exact same dynamics. They're just doing it in larger amounts. And so what's interesting about that, and the reason folks typically like to go down that road, is those bond buyers will typically buy it for lower yields than private investors are going to want. So whereas Trophy Point might pay 8%, 10%, or 12%, depending on your investment level, in the bond buying market, they might buy into it at 7, 6.5, 6, because they're okay with a lower yield because they need to deploy a lot of capital. And so then the institution that's offering the security, now they put out $50 million and they get back, let's say, whatever it is, 40 million, but now that 40, and they keep a $10 million loss position, and that 40 million, now they have it, let's say 6.5. So they get a greater arbitrage spread. So it's beneficial to the investors that are still in at the 10 million. It's beneficial to the operator because there's now more profitability for that lending institution. And now you've got $40 million of dry, unencumbered cash to go lend out again. So that's the mechanics. And so you have deals that are unrated and rated. What that means is there a rating agency involved, like Morningstar, et cetera. So like, we recently got approval with Morningstar that now loans within the securitization that can have a RicherValues report instead of an appraisal and still go through the rated securitization process. Historically, they would only accept appraisals. So, that's kind of the context of what that is and why it might be beneficial to lenders and to the markets as a whole as they continue to get larger and more institutionalized, as it brings a larger investor base into the space who can provide sustainability of liquidity as well as appetite at a lower yield, which then makes it more beneficial and attractive for the operators and investors in the space.
I really appreciate that. That's good to know that RicherValues is becoming recognized in that space, because for those of the investors on the call, we've talked about in my previous updates of Trophy Point getting bigger and bigger and operating at a more institutional level at some point. I think RicherValues probably is like one cog in that, or one important piece in that puzzle as we play in that securitization game. I got a comment from Mike. Great to see you, Mike. Made great sense for a more comprehensive approach, especially to optimize remodeling costs, to optimize the profit on the ARV, not just focusing on increasing the ARV. Yeah, I think what Mike's really saying, and I appreciate you bringing this up, is it's also about optimizing the remodel costs so that Trophy Point doesn't risk as much dollars on the remodel, and not about just increasing the ARV, because we care about, on the Trophy Point side, not lending too much on the remodel if we don't have to, because it's more dollars at risk. Valerie asks, I guess it's to Rodney, how long has your company implemented securitization? Looks like you just got started with that, Rodney.
Yeah, so real quickly, just to correct on terminology. So we're a diligence provider, so we're not performing securitization. Securitizations are performed by what's called issuers, is the holders of the debt that now have the portfolio of loans, and they manage those loans and own those loans, and then they work with the securitization company to issue that security. So we don't implement or whatever the wording was, the securitizations themselves, but the institutions that are creating and issuing securitizations are now starting to utilize richer values instead of appraisals for those portfolios because they're doing it so they can, again, same reasons Trophy Point is doing it. We want lower risk. We want better protection of capital. We want more insight into these deals. And we want faster speeds at origination rather than waiting 3 weeks for an appraisal. So those are the reasons why they are choosing richer values. And so our reports have been, moving their way into that world of securitization by those issuers. And that's really been over the past, maybe 3 to 4 months as that's started to go that direction. So it's very exciting for us.
Yeah, it is. I think what I also like about this sort of evolution is that in one hand, it opens up our space to more investor dollars. Like the opportunities increase because there's more dollars coming into the market, and securitizations are a big part of liquidity and all that stuff. And so that's great for general investors. And I think it's also great for Trophy Point knowing that there's more people interested in what we do, because it's tough raising money from investors all the time, and being able to access capital markets is a good thing for us in general. Well, that being said, Rodney, thank you so much for joining us. I still appreciate you coming. I still appreciate you sharing the RicherValues story and how you help us. You're an integral part of our team. We view it as a partnership. Our line of credit partners view it as a partnership. So thank you to the entire RicherValues team as well for all the stuff you guys have done and how you do it, because that time, the way you do it matters a lot to us. So thank you so much for joining us.
You got it. It's our pleasure. We love what you guys are doing, and you're growing, and you're a great success story. And we're just happy to help you keep climbing.
Thanks so much. Well, everyone, have a great rest of the week, and I'm only a phone call away if you need anything. Thanks so much. Bye.